you never go broke taking a profit. That's from the trader world. And sometimes I think long-term investors could benefit from understanding why that's an important piece of wisdom.
This is a great portfolio for someone who ain't you, who wants to retire soon. But if you're a young investor, this is, I mean, take a swing.
And I think this is a strength because many investors overdo it. They overcomplicate their lives and they're in monkey's way, just jumping from branch to branch and screeching and howling.
Like if you're not having these conversations with your friends and family, then, you know, maybe raise it over Thanksgiving dinner or something later this year. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Christoph the Monkey Piekarski. This week, we always talk about how it's useful to explore all sides of an investing thesis. So today, we are going to step into each other's animal-shaped shoes and call out the bull case for the other's portfolio, and we're going to critique our own approach. We also got the same question from two different listeners. How do you decide when to trim a position? So we'll get into that as a bit of an owl's nest segment. Plus, Christoph is going on stock safari with White Fibre, another AI power compute stock.
Badger, animal-shaped shoes? Step inside our animal-shaped shoes.
Honey, badger claw marks everywhere I go.
Oh man, yeah. For our YouTube visual learners out there, you will see that Monkey is wearing the closest I could get to a badger, which is a raccoon. And funny enough, I have a raccoon visitor at my house now. She has little babies, and we see her walking across the fence all the time. But yes, this is Monkey as Badger, and I'm drinking my morning coffee from Team Badger's mug. I'm feeling oddly more proper, like more prim and proper than usual, you know? Monkey sounds notwithstanding, I feel more dignified for some reason.
Well, you're going to have to do the whole stepping into badger shoes with a British accent, so warm those vocal cords.
You know, yeah. Okay. The Pole raised in Brooklyn, living in Texas, doing a British accent. That's gonna go over just great.
Looking forward to it. But before we get there, we want to tell you guys about a very exciting contest that we're running right now, ready for next week's episode 100 live stream, which is an exclusive live stream for Patreons. But if you're a Patreon of the show, you can enter this. We have teamed up with our partners at fiscal.ai for a special contest. The winner is going to receive a full 1-year professional subscription to fiscal.ai. That's like $750 worth of value. And that $750 in value, that could turn into thousands of dollars in investing returns with the excellent market-leading insights you can get from our partners at Fiscal AI. The challenge: create a compelling data visualization. Make it simple, make it interesting, tell a story with your visualization. We're going to judge all the entries live in episode 100, and the winner's going to get that $750 sub.
You know what? These kinds of promotional contests at other joints are usually a bunch of hogwash. This ain't that. This is legit. This is like a real prize over here, for real. Especially if you're getting serious about your investing. This is no, we're not throwing peanuts at you. And so we really, really hope that all of our Patreons enter this contest. If for nothing else, it's a great exercise to do.
For real, right? Like, first prize is the pro subscription. The second prize, everybody wins. It's like the opportunity to get on to fiscal.ai. If you're not signed up, go sign up at fiscal.ai/wildlife and do a free trial, right? In your free trial, you'll still get some incredible capabilities. You'll get all the pro capabilities for your first 2 weeks. And just starting using tools like that is going to massively uplift your investing game.
That's right, Badge. You know what they say in the investing business. First prize, a brand new Cadillac. Second prize, a set of steak knives. Third prize is you're fired. That's my that's tapping my inner Alec Baldwin. I am wearing the coffee is for closers shirt, but yeah, I mean, yeah, I mean, you need this tool, and so good investors crunch numbers. So get at it, Patreons, animals.
I want to show you what a graphic I made with the custom metrics, and it will give you a sense of the kind of thing we're looking for. Here is my custom graphic showing Carver, that crazily expensive restaurant chain, and the number of restaurants they have open against the market cap. Like today, this is like $19 million per restaurant because they got about 400 restaurants out there. That's pretty expensive. And then you can go compare that to like Chipotle and McDonald's and other competing brands. You can get a real sense as to whether that valuation is out of whack. That's the kind of story we're looking for in this contest.
Yeah, and you know what I see jumping out at me right away is there's a simplicity to this story. There's two lines, and the lines are diverging, which, you know, visually, when you look at something, you want it to pop. Also, nice use of the two colors, two different colors. It's
Great stuff. Well, I'm looking forward to seeing your guys' entries, and we're looking forward to judging them live in episode 100. All right. Are you ready to put on your Badger shoes?
no, I ain't putting on Badger shoes, but I got my Badger cap. I sharpened my claws, and I got my Badger mug. So yes, I am ready.
This was your concept. How are we going to do this?
Okay. Here's my thinking. In prep for episode 100, I think it feels to me like a good time to go over our portfolios, you know, just to talk about our investing strategies, because they're kind of fascinating at this point. They're quite, I think, divergent, but I'm always looking out for biases, and you know, it's not that hard to pump your own your own bags, as the kids say on today. And so I think it's much more interesting to make a good case for the other guy, or and to be able to critique yourself rather than, you know, because it's just, yeah, the confirmation bias is always strong. The force is strong to think what you're doing is the best thing in the world. And so I proposed that for this episode, I take on the role of Badger, and meaning I look at Badger's portfolio and say, this is why this is a strong investment strategy. And sort of simultaneously implied is going to be a critique of how Monkey does his business, you know, why Badger's is stronger. And so I think it's a great thought exercise.
So how are we going to do it?
Shall
Do
we?
you want me to go first? Do you want to go first?
Yeah,
What am I
yeah.
doing? I'm gonna be like pro monkey, and then I'm going to attack myself.
Yes. Well, you know what? Let's keep it simple for now. My main goal is to tell our audience why, when they look at the Wall Street Wildlife King of the Jungle portfolio, which is linked on our Patreon page, when they look at your holdings and your portfolio, I'm making the case why they're looking at gold, pure gold, Badge, pure gold, right? And then you might do the same for Monkey. But I think in there, as we do it, we'll probably end up critiquing ourselves. And if not, then that could be the third segment.
Okay, so let me tell you about this incredible high beta bet of a portfolio that the monkey has. And Christoph, that's like just the two things I've got in the doc. This is an extremely concentrated portfolio that is suitable for an ultra risk accepting investor who's adding new money to the portfolio regularly, and they are diligently tracking their companies and being ready to react to breaking news. This is like a fantastic portfolio for a younger investor whose life isn't going to be materially impacted if like the market cycles back to risk off and if like the ass falls out of the market, because it's essentially a five stock portfolio of really high conviction bets on well researched secular growth trends. And with 35% of the investment in EOS and then like another 23% of the whole portfolio in IREN, you've got two very strong, like energy focused plays in this portfolio. Half of this portfolio is energy. And that is a really interesting secular growth trend right now. What it tells us is like the monkey who designed this portfolio has done his homework and he's really studied what like the changing energy mix and the major problem being faced in the US today with basically not enough power to run all the AI data centers and to keep the lights on. Because the US has like an aging, broken energy infrastructure. Like you guys get blackouts or brownouts all the time. And that ain't good enough for a modern AI first economy. So I like that idiot Badger, he was looking at like solar stocks and he lost his ass looking at solar. Like the future is around batteries and the future is around like grid scale batteries and also companies like IREN that can come up with innovative business models that put like the economics in place to allow them to build these like this huge energy infrastructure and monetize it through things like cryptocurrency until they kind of get to the scale which they are now, where they're actually like selling AI data center capabilities, like all these different legs of the stool working really well together. So this is a portfolio that is designed to maximize the benefit of the risk on investing environment we're in right now. But the owner of this portfolio has got to keep like an iron grip and an eagle eye on what's happening with macro, particularly what's happening with energy and what's happening, especially with like these five stocks that make up the bulk of the portfolio. Because if something goes wrong with one of those, that could really set the portfolio back like a chunk of time.
Not bad. Okay. I think you had to swallow hard at some of those points.
No, I think fair. I mean, okay. I mean, if I come out of like being the monkey, like I managed to reconcile myself with this because I think this is a great portfolio for someone who ain't you, who wants to retire soon. But if you're a young investor, this is, I mean, take a swing because if you blow up, you've got like another decade to repair.
Okay, I'm so tempted to start, adding more crosstalk, but I don't. Let's not do that, right? So that's your best pitch, correct? For Monkey. Okay, fantastic. So let me tell investors why the Monkey portfolios is full of hogwash and rotten bananas, and why Badger is really where it's at. And so when you look at Badger's portfolio, the first thing that jumps out at you or jumped out at me is that almost predominantly this is a portfolio made of world-class companies, like classy companies. I'm picturing like a ballroom dance. This is suit and tie and tuxedo territory. You got the Rolex, Rolexes on the wrist. It's like a place where Roger Federer would feel right at home. Uh, except for Greg's. Greg's sausages. Greg's sausages somehow snuck into the to the high society ballroom somehow. But I'll overlook that. And what's the consequences of this kind of portfolio? Immediately, I think Badger sleeps well at night because, as one example, he's not going to be worried whether Google or Amazon are going to go out of business anytime soon, or Mercado Libre, and not even out of business, but they run the world. So Badger gets to sleep well at night, no questions asked. Secondly, the way Badger invests, if you're over on our Patreon, when we have a trading channel, the Dolphin channel, you'll see that he's not as active as Monkey is. And I think this is a strength because many investors overdo it. uh, they overcomplicate their lives and they're in Monkey's way, just jumping from branch to branch and screeching and howling, whereas Badger is just, strolling on the ground, collecting his acorns here and there, but there's just not that franticness of activity. And for many investors, that's, really key. I was going to say something like, oh, and also Badger's approach is slow and steady. When you invest in a company like Google, which is 3 trillion, and Amazon, which is 2 trillion, and CrowdStrike, which is 123 billion, you're not expecting things to go up 40% in a year or 70% in a year. And so to me, it's like this is the slow and steady, methodical approach. And yet, he has one investment up 1,043%, another one up 682%, another one up 331%. And so to me, it seems like this magical combination of secure, slow, and steady, and these absolutely astronomical gains. Now, granted, we've entered good phase, and Badger chose really wisely, and so on and so forth. But it's like slow and steady does not necessarily mean you're going to be stuck with nothing but Greg's like companies and growth. Uh, Also, I need to mention, and this is maybe outside the purview of the King of the Jungle portfolio, but it's because Badger's my co host, and many of you also know this. He's compounded his growth rate at 22% for 20 years. So that's the kind of proof point that says uh, this is not something that was a one and done kind of like many hedge funds. They have one great year, advertise these insane returns for whatever reason, and then they go back to underperforming the market. To be able to have that kind of growth rate over that long period of time is just the highest, I think, testimonial that any investor could offer, and Badger has it here at Wall Street Wildlife. Um, when you listen to our show, you'll see Badger very frequently pulling up charts made by FinTech AI, and he uses that fundamental data to his advantage. So when he makes a pick, you know that it's backed by some serious, I would say, financial literacy and number crunching, and that's behind all of these picks. It's a lean portfolio. Uh, I think here, Badger and Monkey are at this moment pretty much exactly the same in terms of the number of stocks, 20, including a cash position, though Badger's now is at 3%, Monkey's is at close to zero. But I don't think it's an accident that we both have about 20 companies. I think for both of us, it kind of feels close to right. The difference, though, to Badger's credit, is that his positions are much more evenly spread out. Rocket Lab is at 15%, which is high, but that's because it grew 1,000%. Um, but in general, if Rocket Lab blows up, even that won't destroy the portfolio that badly because each position is relatively sizable, so equally balanced, and I think that that's a strength. Uh, I'm sorry, I'm trying to here's the best way I could paint Greg's. I was gonna say, or the Greg's portion of your portfolio. I was gonna say in Badger's portfolio there is no funny business going on, and even something like Greg's sausage rolls, which will make you sick and clog your arteries and destroy your life. There's a reason for it, and Badger was willing to look in a shadowy corner of the market uh, and say, you know what, this is a good play based on fundamental valuation and income, and it's just very different from the rest of his portfolio. And to his credit, I think that shows that he's not necessarily only looking in one spot. He's willing to take on a company like Greg's. The last thing I want to point out is that it's very clear to me that this is a portfolio that has focused on what I would call the maybe the best business model of all time, which is subscription as a service or some sort of derivative of that. And that's because I mean, to newer investors, when you could make some sort of software platform once, you invest a lot, but then that model, as long as it gets bought by large corporations, that model just keeps giving and giving at margins that are through the roof. And specifically, Badger focused on not just any old software as a service uh, business model, but specifically the cybersecurity market. And why is that genius? Because he's reading the tea leaves of the world at large and saying, okay, AI is coming. Some software platforms may or may not make it, but you know what? Cybersecurity is definitely going to be around. So it's like I see it as a layered cake of correct thinking that's directionally correct, and when you compound all those things together, you have these massive tailwinds working in the investor's favor. And because these stocks are such strong companies, you could reliably, to go back to tie up my case for why Team Badger is the team you want to be on, uh, over time, great companies keep getting better and your portfolio goes up and to the right, and you don't have to sacrifice much sleep in the process. And so that's why I think anybody that's on Team Monkey is absolutely ridiculous and foolish. You got to get yourself some Team Badger stocks and tighten up that tuxedo. Make sure that that bow tie is nice and tight right there. You know, polish off the diamonds on the Rolex, and you're good to go.
Yeah, very good. Thank you. Thank you. I think there are some significant problems with this Badger portfolio, though. And you have to look at the bigger context because that Badger guy, every month, he publishes his whole real money portfolio, and that's where his focus really is. And he flags, I think, 8 companies as being high conviction. And he currently doesn't have Rocket Lab as high conviction, but it's like a 15% allocation. So that is like a massive mismatch between
Mm.
conviction and allocation. Like this guy should be either pulling his pants up and saying, I do believe in this thing, or he should be cutting it back substantially.
Maybe you know why okay, in some sense I think you're right. All investors face this problem where for whatever reason there's divergences between, yeah, you said it well. uh, in fact, that's what our portfolio review was so good for. If you go back to what, episode 91, 92, 90 or 91, the two-part mega portfolio review, that's where we discovered, looking at our own stuff, really how we felt, and then made some adjustments. That said, Badge, the reason your Rocket Lab is at 15% is because it just friggin' ballooned, because it gained 1,000%. And sure, maybe your conviction is not as high as you would want, but when you have a stock that performs so well, the never sell ideology, I would say, is more often right than not. And yes, you could trim around the edges. I think that's perfectly reasonable. But I'm not sure that it's necessarily that gap that you're talking about, it'd be very different if it had more to do with like the thesis broke somehow, or the company's not as strong as you thought, but the size is sort of like it wasn't your fault that it went up 1,000%, if you know what I mean.
Yeah, he's got this nice problem to have, but he should be dealing with it.
Yeah, so deal with it.
Yeah. And then, like, he talks about being like diversified and like this is like a mature portfolio that guy's like living on. But it's really, if you dig into all of these companies with one or two smaller allocation exceptions, this is like US tech. And if the ass falls out of US tech, like this portfolio ain't diversified.
In some sense, yes. But then I immediately get this feeling of diversification. You know, you diversify just to have different stuff. But what is the major trend in humanity? I mean, especially in a time of AI, it's technology. I mean, there's just no, I don't know, there's just no other way about it. So to diversify into something like, I don't know, restaurants or retail or this, that, and the other thing, when you have this paradigm shifting tidal wave, reeks almost of trying to be too cute for your own good, too clever for your own good, when the most obvious thing in front of you is, you know, the elephant in the room. Just go with the elephant in the room. And in that sense, I think you're perfectly sort of set up to take advantage of this massive tidal wave, but in different ways. I mean, Google is quite different from Amazon. Yes, they're both tech, but you know, they're different beasts. They overlap in some ways, but they're not identical. Axon is a tech company, correct? You call it obviously a tech company, right? But
Yeah.
it's, you know, it's law enforcement. You have your cybersecurity stuff. That's very different from what Amazon does. It's almost like, you know, it's almost too, I think, simple to say, oh, these are US centric tech companies. Like, what isn't? And actually, further, in Badger's defense, you also have a company, what, founded or based in London, Wise. You have ETF, India ETF. You have Novo, which is Netherlands, right?
Yeah. Although mostly like they get their money in the US, so it's really
Okay,
a US
okay, all
company.
right. So
Yeah. Yeah.
fair enough. You obviously have Greg's, and you have uh, BYDDY, which is a Chinese company. You're actually surprisingly, I think, multinational, not just US tech centric.
All right. I give in. You're right. That Badger guy's a genius.
You are a genius.
Hey, this is healthy because, and actually, I also critiqued my real money portfolio, and we won't chat about that on the show. But in doing this exercise and taking like the bear and trying to argue against my own portfolio, I think I've, come to a couple of quite useful conclusions. That, like, I've got just too much of a long tail. I've got too many positions in my real money portfolio, so I might go through and do a bit of weeding out. But you do this now. You do, attack your own portfolio. Let me hear your bear case on the monkey setup.
To be fair, I think I have somewhat of a similar problem as you do with, for example, Rocket Lab. I made the problem actually might have been more applicable even 6 months ago when I was heavily invested in EOS and Iron and AST, but that's because the story part of those three was still predominantly story. Now, you know, the evidence behind all three of those picks, I would say, is just overwhelmingly positive. But that said, those positions, the three big ones, 35% for EOS, 24% for Iron, and 16% for ASTS, that's predominantly because they grew so massively. Uh, so, in some sense, yes, if anything happens to those, my portfolio drops precipitously, and that's just dangerous. So, my sleep well at night quotient is much, much lower than yours. That's me saying the risk reward here is much higher. And yeah, for older investors or investors at a different stage in their careers or without income, I would say at these allocations, this is way uh, too anxiety inducing. But at the same time, if you're part of our Dolphin Trading channel, you'll see that I actually did trim EOS a little bit, and I did trim iron a little bit because when you're at 35% and you're at, I mean, it felt like not that my hands were tied my back. It felt silly to continue taking that huge risk when specifically in my context, I had the most, to me, obvious place to put that extra money, which is into Harmony Biosciences, which is, I would say, as undervalued a fundamentally company as there is. So it's not that I was just gonna trim, but it was for very good reason. But yes, it's imbalanced. Uh, I was though one more thing, Badge. I was a little disappointed in when you were saying when you were praising Monkey's portfolio. You didn't talk much about the tail, and that's probably because percentage-wise, it's you know uh, almost irrelevant compared to the top five, right? But But to me, the tail matters because these companies are all companies that I now have conviction in. They're on the scorecard, and just because they're small in terms of percentages now, that's not because I don't necessarily believe in them, but because the capital allocation, I don't, we only put $200 a month in there, and it's hard to compete when EOS is going up 10% every day, right? So I think I don't know if you're open to it, but maybe you could say something about the 1% companies in there or the Nintendo, which is 0.4, even though I've been holding it for a good while.
This is, I mean, I've got to take my like pro monkey shoes off though, because I do like. So I'm just going to sort of speak in the round now. I'm not trying to be pro or con anyone. I like the idea of like the barbell portfolio, and you've got like at one end of the barbell, you've got like your, the big, the solid stuff, or the like your main positions, like the stuff that really drives the portfolio. And for me, that's more mature companies, and for you, that's like your tiny handful of super high conviction bets. But it's the same thing. You've got like a big chunk on one end, and then the other end of the barbell, we've both got more, I guess for me, it's more speculative plays. And I've got like a bunch of them because I kind of don't know what's going to win. And I want to see kind of just how they perform over time. And on your end of the barbell, like you've got the same number of stocks in total, but actually you have a much smaller percentage allocation to that end of your barbell. So I think the strategy is good. But actually, honestly, I think your allocation to those kind of renders it a bit useless because you've got so much in like your top six. Like Nintendo, you said there, right? You added it a little while ago. You do genuinely believe in it, and it's actually a good counterpoint to the kind of stocks that you own because it's like the big behemoth and reliable and lower risk. But it's not going to double because it's not that kind of company. But if it did double somehow, it's still less than a 1% allocation. It just can't move the dial when it's such a small piece.
It's interesting because I think it's up 60%. But that was,
Well, then that
some
means it
months.
was like a 0.2% thing when you added it, right? But
Yeah,
you
yeah.
still can't move the dial. Like at least I've got the same problem actually in my real money portfolio, where I've got like a bunch of stuff that's sub 1%, like I've got 10 things that are less than 1% allocation in my real money portfolio. But at least in my King of the Jungle portfolio, like I don't know, well, like Greg, there's a simple one. Let's say like something towards the bottom, like Adyen. Like I believe in that company. It's a 3% allocation. Like if Adyen performs well, it could become, a 5 or 6% allocation. That is somewhat material in like a 20 stock portfolio.
Let me focus. This is making me think about for one stock right now specifically. Real, genuine, real problem I have. Maybe we could talk this through. I love Transmedics.
Hmm.
It's a company I just know very, very well. I pitched it on Seven Investing. Uh, just I love it not only as because it's a great company. I love its mission. It's now expanding internationally. Italy of all places is going to be the first European expansion, and I recently added a little bit to it. I think it was in the past month in our Dolphin channel, but it's only 1.2%. And so theoretically, I would want that between 5 and 10%. I have that much conviction in it, not least because, as you know, I love smaller sized companies because I think that's where you get the sweet spot of the hypergrowth between ideally, I would call it between 1 million and 10, I'm sorry, 1 billion to 10 billion ish is kind of where I like to play the most. And Transmedics is right in that sweet spot at 4 billion and change. So I want that bigger, but one, to play by the rules, I only get $200 per month, right? And then every time I get that money and I'm like, I should buy more Transmedics, I'm like, but wait, but Harmony is more timely. Or wait, no, Iron just is doing this massive thing right now and it's more timely. Or my obsession with Chainlink. And so things keep taking precedence. And yes, you're right. One move I could make is by selling a lot of the EOS or Iron or AST, but that then violates my other fundamental rule, which is when you pick a future world class company and it's performing like, it's just executing on all levels, then why are you all of a sudden getting cute and, other than the risk management stuff? So I kind of feel, uh, conflicted here.
It's an interesting one to pick. I'm also a fan. You brought it to my attention like years ago at Seven Investing. And funnily enough, just coincidentally, I also have a 1.2% allocation in my real money portfolio. I don't own it in the King of the Jungle because you kind of got there first and, it was your stock. I don't want to step on your hunting grounds. So, like, in my real money portfolio, that feels about the right sized allocation. I'll probably be happy actually having 2% in that. So I might add to it. Actually, I have been thinking about that.
Actually, Bad, can I challenge that claim right there? Why not? I mean, I'm gonna toss out a number. Why not 4%? Meaning like to you, like four times as much, so not insignificant. But if you love it, you know it, and all of that stuff is there, and it's only 1.2%, why so small?
Because there are like 10 other stocks that I have higher conviction in, right? In my real, like if, so I publish this on LinkedIn and X and everywhere every month. So this is like my current real money portfolio. This would look like a week ago when I did the extract. And there's Transmedics in position 19 with 1.2% allocation. Like I like the company and it is like my barbell. Like it's one that I want to see executing. I see it as sort of medium to high risk, I suppose. And, you and I think about risk in very different ways. So it's right that we might come to a different conclusion about that. But it ain't one of my high conviction ideas. And and so, why not 4%? Well, actually, this almost brings us on to like the Patreon question, but we'll come at that from a different angle, right? Because like the way I build a position, like when I start, I think I've bought Transmedics twice, I think. And like initially I'll buy like a 1% position on not a huge amount of research, like enough to validate, okay, this market makes sense. Like I kind of like the story. I want to follow the story. So I'll buy like a 0.5%, 1% position, and then I'll just watch it execute for a couple of quarters and I'll listen to the earnings call and I'll just try and see is my idea about the company kind of playing out the way I expected. And then I'll add. And I think that's where I'm at. I did that. I watched a quarter. The stock sold off pretty heavily soon after I bought it. I did a bit more homework, watched like another earnings release, and then I bought again. I think that was the story for that one. And now I would potentially add again, but when I add again, like I really want to see like a year's worth of validating my thesis, and we're kind of coming up to that point, which is one thing I'll add again. And typically, I'm quite structured. Like typically, I'll add and I'll bring it up to a 2% allocation, which is why I kind of threw out 2%. For me to add money personally beyond 2%, I have to really believe in that company. So, you know, you can see those stars on my portfolio. Like there's 8 stars there. I've given the gold stars to stuff I believe is like high conviction today at today's valuation. And honestly, actually, I don't really know. Does Transmedics deserve one of those stars? Because I haven't done enough deep work. So I'd have to do that. But regardless, I'm never going to take something from, it's too big a swing to go from like 1% to 4%. I'd want to do it in stages, building my knowledge and building my confidence as I build my position.
Yeah, that's fair. That's fair. Uh, I think one, you need to go and do some homework on Transmedics because the last earnings call was just uh, bonkers good. So yeah, that would be step one for any investor, right? This is why we're good for each other. I'm telling you as directly as possible, high on your priority list, revisit Transmedics. That'll help with the conviction. And then you could get rid of some Gregs. You know, there's a there's an unneeded 0.5%, free up some capital. I don't know what the heck Airtel Africa is doing, so I'm not going to speak out of ignorance. But there's an extra 1%, a tighter portfolio, and then a happier Badger down the road.
So this was a good. This was a good exercise. Like, and I think you said we should do this before episode 100, and it will get us in a good frame of mind. But actually, that was a really good shout because I've never really like tried to attack my whole portfolio in the round like that. I do try and bear case my individual stocks, but I haven't really done that to my portfolio. So it's a good exercise, and I think I do have some conclusions I need to like dwell on now for a couple of weeks that might impact my real money portfolio. So like if you're listening, maybe do this for yourself. We did a kind of pull apart of a Patreon's portfolio last week, and I recall that one of our conclusions was there's just like a ton of stocks. That guy had like 46 positions, and your good advice was, look, can you really be high conviction in 46 companies? You just can't do the work to a sufficient degree. Like it will probably be healthy just to go and figure out what your bottom tail is of the stuff that you really, really don't either understand or believe in, and then just give strong consideration to like cutting those things out of the portfolio. I think that's quite potentially quite powerful thing to do because then it frees up capital and you can deploy it into your higher conviction picks, and you've got more brain power to focus and time to focus on the stuff that you're really interested in and believe in.
Amen and hallelujah. I need to correct you on one thing though, Badge. Uh, Monkey's portfolio, as of time of recording right now, is now over 10K, and I would say that's real money. Uh, and you know, everyone is starting from different bases, but any way you slice it, $10,000 is if you found $10,000 on the street, I don't think anyone would say, "Oh, that's not real money." And so we just need a better name for we have our jungle portfolios, and maybe we have the savannah portfolio or the desert portfolio or the lake portfolio, whatever. But just for all our listeners to emphasize this, our king of the jungle portfolios is as real as the money gets, and we take it very, very seriously because we're, you know, this is what our show is kind of structured around. So we're not, pardon the pun, this is not funny monkey business. This is real stuff.
Yeah, agree. And like in some way, okay, so I got basically like we're right to refer to these as our king of the jungle portfolios because it is a contest. I need to find a different word for my other portfolio that's not real money because you're right, they're both real money. Am I allowed to call it that my main portfolio? Would that be right? Or
Yeah, main, yeah,
lifestyle?
it's good for now, maybe.
Okay.
Actually, no. No. That's also problematic because that's like Maine and as the weekend would say, my
How about
main bitch and
retire
my
my
side bitch.
retirement
Yeah,
portfolio because I'm retired, right?
yeah,
Uh,
or maybe legacy. Right, exactly.
it's not like C.
Legacy portfolio.
All right, but anyway, one. Okay, so let's call it my retirement portfolio, and I'm now in retirement, so it is quite important to me. Like in some ways, I prefer the construction of my King of the Jungle portfolio to my retirement portfolio. So there is a lesson there for me, like in how I should maybe make the retirement portfolio look a bit more like the King of the Jungle portfolio.
Yeah, I mean, right. The fallacy that I'd like to point out, which we talk about a lot, but I don't think it's one people take seriously, is the one about inertia. And it's like, oh, I have this thing. And so you just, when you look at your portfolio, even if months or years have gone by, you just don't stop to ask yourself, do I still want this thing? Because it's already there. So it just takes more effort to sort of say, and you know what the obvious workaround to that is. I've brought it up to listeners quite a few times, but I doubt people take advantage of this. It's saying to yourself, if I did not own this thing today, would I buy the same exact amount today? Because that's literally what you're doing when you hold something, right? You're saying, yeah, if I didn't have it, I'd buy it today at exactly the same price. Tax considerations sort of bracketed it out. But if you can't emphatically say, yeah, today I'm going to go out and buy, a slug of Greg's sausages, then you should sell it.
Let me let's do this topic because this was we had this question, exact question, and we've stumbled into answering it already, from both a Patreon and another listener to the show. And I'm just going to quote like our Patreon's version of the question, and it's from our Patreon Zipper, and he's like, guys, I've got a question about trimming positions in a portfolio. I'm a new investor who started this year, been watching the channel, so trying to catch up. I'm wondering about strategies about trimming. The market continues to go up. Some positions have got crazy overvaluation in them. It's making me ask questions. Any suggestions about trimming? How much? Yeah, how do we answer this question? So back at you, because what you just started describing, and you don't need to repeat it, is like that is a good lens into if you wouldn't buy the allocation in the thing that you currently have, if you wouldn't buy it, well, then you probably shouldn't own it because by doing nothing, it's essentially the same as saying I would still buy this thing today. If you gave me dollars, I would turn them into this stock. So if you wouldn't buy it, that probably is one of your first reasons why you might trim the position or sell the position entirely.
Okay, yes. So let's take some rounds. Let's each take a couple of stabs at this. So that's point one. I would invite everyone, sorry for being redundant, but in the trades channel on Patreon, what Badger and I are trying to do more and more of and get better at is when we post a trade we make, it's the rationale that's more important because obviously we are not teaching people to blindly follow whatever we do. That's just silly. And we are not, it's not financial advice and so on and so forth. We're teaching you how to fish. So recently, I trimmed a little bit of EOS, and there's two reasons why I did that. One, yes, at some point, when a position just balloons so freaking large, like it's just basic risk management. I didn't want to trim it. I really didn't. But I said I want to get this at least close to 30%. And damn it, it keeps going up, Badger. It's now back to 35%. So, I'm in the same boat. But that's one, like basic, like this is I have too much of this. But that was only part of the equation. And I already said this, but bears repeating, I had a very clear place for the new money. It wasn't just gonna now loaf around. I very much wanted more Harmony Biosciences. So when I have that combined 1-2 punch, to me it's sort of a no-brainer, despite having complete conviction in EOS at this point.
Yeah, that's good. And like you're there. If I sort of framework this a little bit, like there we've got two completely conflicting reasons why you might want to trim. Like you might trim because actually maybe the thesis has fully played out. You had like, I don't like price targets. I hate the kind of concept of that. You believed a thing would happen and that thing has now happened and you kind of won, like you succeeded with that thing. Or maybe the stock is looking rocky, bad decision by management, they overexpanded, like macro's gone against them, like it's looking a bit, the stock itself is looking like it's in danger. And so, but not so bad that you want to sell completely. Like if management have like lied, then I'm out, I'm gone. But if they've made a mistake, like we make mistakes, and if they're clear, they acknowledge that and they understand that. If I still believe in the company, but my thesis is kind of shaken, but it's still intact. So those are like stock specific reasons to trim because something's happening with that stock. But what you're describing there is the totally different set of framework, which is like the portfolio specific reason to trim. And you could be 99.999% sure this stock is going to go to the moon. You probably are with EOS, but you should still trim if, you don't want to bear that in your mind. I think you're delusional because I do think it's like highly speculative. But even if you're super confident about that stock, there's still the chance it doesn't work out. Something goes wrong, like an asteroid hits their headquarters, right? Anything can happen. And and so for that reason alone, even though you believe in the company, that's a good reason to trim because you're managing your portfolio risk exposure.
You know what now I'm afraid of, Badge? Is some like rabid renegade badgers, like dressed up as ninjas, invading EOS headquarters at night, sabotaging all the wiring and all the plumbing.
Well, this is like the raccoons at your door. Those are the badgers, right? They come to check out your portfolio and see which HQ they need to go and scurry up next.
One more thing about trimming. Back to the trade channel. Listeners will know I recently trimmed 25% of Astera Labs, ALAB. And that was also another reason. To me, that is a company firing on all cylinders. It's got the AI momentum. I couldn't be happier with its execution and its partnerships, and it's just as solid as they come. But yeah, sometimes stock goes up so stinking fast, so soon that the valuations get stretched. And so when I bought it, it was for valuation reasons. But nearly 300% later, over whatever 3 months, 6 months, 3 months period, I asked myself the same question. This stock is no longer cheap. The momentum stuff has got to, I mean, maybe not has got to be is an overstatement, is most likely near a peak or a crescendo. And again, I had better places that felt much safer in terms of margin of safety. And so I prevented myself from binary thinking, like all or nothing. I didn't want to get rid of Astera Labs. So 25% to me felt like exactly what we're calling trim. You never go broke taking a profit. That's from the trader world. And sometimes I think long-term investors could benefit from understanding why that's an important piece of wisdom. And yes, some of this stuff is contradictory because never sell versus you never go broke taking a profit, and that's why this is an art form. But I slept very well at night, having taken some profit and reallocated to something undervalued.
So I think actually I think we've done a pretty decent job of that topic, like when and how you should trim. And no one can tell you the answer to this thing, right? It's very personal. If it's about your portfolio, like no one else's portfolio looks like your portfolio, unless you're one of these idiots who does like copy trading, where you just copy someone else's portfolio. Like, don't do that. It's a bad idea. And you will have your own personal conviction about a company. Christoph and I both own Transmedics, but we have different conviction levels in it, and that's why he wants to have 6-7%, and I want to have like 2%. Doesn't mean either of us are wrong. It's just how it fits within the context of the portfolio and our own knowledge of the thing. Because I don't own it because Christoph told me to buy it. I only did that with EOS. I own Transmedics because I did the work myself. And I didn't do enough of it, which is why I've only got 1.2%.
That feels satisfactory. Yeah. Shall we move on to my stock safari?
Yes, let's do that.
I recently added white fiber, which is my number 15 stock in my portfolio. It's still a introductory small little nibble position at 0.3%. But my rationale here was trying to not to overthink things. Sometimes, I mean, I don't know how to say it. Sometimes in investing, things can be simple. And I'm looking at the basic fact that when Google and Oracle and Microsoft are announcing this absolutely insane capital expenditures into AI infrastructure to the tune of, when you add those up, it's going to be trillions of dollars, and it's seemingly only accelerating, which is very, very different from what we saw with the internet bubble, right? That was a bunch of rah-rah, but not much real money. When companies are saying trillions of dollars are going in this direction, and you know, or I know, because I've been studying iron now for over a year and a half, that all of that can only work if you have enough electrons and GPUs and data center clusters making it, actually powering it. Then I know exactly the sector I want to be looking at. Having already put iron and cipher into my portfolio, I did some digging on the interwebs, and lo and behold, there's a new spin-off IPO that's basically revolving around. They're not looking to be. They're transitioning from like one of those Bitcoin tech, kind of that mix that Iron used to be, into a pure look. We're just going to build these AI data centers in this pure sense. So we're not monkeying around with the crypto stuff. The market cap was under a billion, so small potatoes when the supply and demand is so out of whack. That means what, Badge? That the prices and margins they're going to be able to charge are going to, like, it's, a seller's market. That's two. And they actually have a little bit of a special sauce in what they do. Iron is genius because they figured that this was going to be a thing 4 years ago. So they decided they're going to, build from ground on up the highest tech uh, data centers in the world based on first principles. But they're so far ahead in terms of, call it, process, right? Because all of this takes years. So no other companies could really do it as well as Iron can. But these guys are saying, wait a second, instead of building these things from the ground on up, let's do what they're calling a retrofit model, and let's just find the best locations in the acreage and turn old properties into these new data centers, which gets them to market way faster. And in this moment of time, it's like free money hanging from the tree. Who could actually do this when the demand is just so stinking high? So the case study here that y'all should examine is they bought up this huge acreage property in North Carolina that used to be, I believe, an old mattress firm or one of these data centers. You'll see all of their uh, what's it called, data centers in development. They only have one that's running, that's Montreal one. The other three are in the process of being built out, but the North Carolina one is going to be friggin' huge. But it's going to happen faster than some of these other companies, and so that's kind of their secret sauce. Uh, and right now, the megawatt hours are just being sold for ridiculous amounts of money. Our our dear Patreon uh, posted a fantastic overview of white fiber on X. So check out our Jungle Community Lounge for that link. And when you look at some of the numbers, the megawatts selling for like 10 million per one, you get a really, really high annual revenue return rate. high margins, you slap on a good multiple, and you get a mega, you get a market cap that's still like four times higher than where we're selling now. So, Monkey only had whatever 30 bananas left in his coffers, but that was just so obvious that I put it in the portfolio, and I recommend everyone follow up and do your due diligence.
Yeah, it's good stuff. I know you said it's sort of different to your, say, IREN, who are doing similar stuff, but they're not monkeying around with blockchain. But the essence of it is quite similar in that, like, there is a bottomless demand for data center compute and energy. Like, those two things go hand in hand. And so, a bit like IREN, White Fiber are creating that capacity, and we're seeing some of these companies like the stock charts to go like parabolic. Did we? Who was it who bought a whole chunk of capacity off of IREN? Was that Alphabet or Microsoft? We saw like a week ago.
No one has yet. Iron. Side note, I don't mean to detract this, but I Iron right now, because it's world class relative to everybody else, is in this truly astonishing position of watching all the Googles and Oracles and open AIs in the world, like scurrying around trying to get all the megawatt hours. And so why is the one with the most to offer not yet signed anything? Because they know they're going to squeeze as much juicy fruit out of those data centers for the highest prices imaginable. So I imagine the contracts they're negotiating now are going to absolutely shock the stock market. That's my theory. So they have not announced any deal yet because they can. They're in catbird seat.
It is telling, isn't it, though, that even like the hyperscalers, these big giant companies, are out there trying to buy up capacity because they just can't build it fast enough themselves.
Yeah, I mean, can I go back and revisit this? Sometimes it's so simple. Theory that I was talking about. I don't know how else. I don't know how else to say it. Maybe people sometimes get worried that if it's too good to be true, it's probably not true. But then at some point you have to just look at the data, right? Like these big deals that are getting signed that I talked about earlier. There's no way around this. There is no magical software program that could get more electrons flowing into these mega trillion-dollar investments now. So what are you going to do? You're going to buy them anywhere possible, and all of a sudden, instead of just owning the one iron and then I added Cypher, now I'm like, what's wrong with white fiber? What, just because it IPO'd 5 months ago, or no, it's not as strong a company as Iron, but what do I care? Like, why complicate this?
Yeah, it's like the basket approach of investing. You come up with an idea or a theme, and then like you just buy like a bunch of things. Even if you want to own, you do want to know kind of who the winner is there, like who's the behemoth in that theme, and maybe own them. But having a bunch of other bits of optionality around the same idea can help you, because then you do a bit of research and you read an article or you see like a thing on X, and you've learned something useful about like a number of stocks that you own.
Right, exactly. And I'm glad you said that, Badge. The other point is, I think somebody asked us on Patreon about these kinds of these three stocks I bought. This goes back to one of our 10 laws of the jungle, the due diligence part. I've been studying iron for a year and change, listening to earnings calls, getting familiar with management, following their journey from clean energy play to changing their name to why are they selling all their Bitcoin all the time to, all of these pieces. And over a year and a half, that's a lot of understanding that I built up fundamentally, right, about the industry, about how it's playing out. So then when a new thing like white fiber pops up, I'm not just all of a sudden taking a flyer on a new shiny thing because it happens to be new. I'm like, wait, all these guys have to do is literally copy what Iron's been doing. And that's what all of these new guys are doing with Bitfarm. I forgot to add Bitfarm because that now I have four of these. Because the situation demands it. So I'm not going to overthink it. I'm not going to spend another 3 months like reading through every slide, right? When in a certain sense, the timing, if you want to, extract a lot of gains when everything is in your favor, it's like, yeah, I need white fiber in my portfolio now.
More concentration in energy. That's what the man with 35% EOS needs. Oh, no, it's data centers, not energy. Sorry. Anyway.
Damn it, Badger. I'm sorry. EOS is up another 7% right now. So soon the stupid thing's going to be 40% of my portfolio. Uh,
That's cool,
I'm
right? You just
sorry. I'm,
no, it's
you
good. It's
know,
good that you're watching it, exercising discipline, and trimming. If you're not trimming every day because it goes up every day, right? Then so be it, right? Manage the risk exposure. It'll give you like you do that in your King of the Jungle portfolio, and you'll have some dollars to like throw at Harmony and like Transmedics and your other ideas. Yeah. Anyway, do you know what I did this last week? Last week, I had drinks in London with one of our excellent Patreons. I was invited for craft ale by our Patreon, Andrew. We had an excellent time. We finished with we raised a whiskey sour to Monkey at the end. And one thing stuck in my mind about my conversation with Andrew, he's like another super interesting guy who's invested in many of the same companies that you and I are. But one thing that I think was really good, like he's investing for his nieces and nephews, like, young members of the extended family. And I think that's a really, really good thing to do. I've been doing that for a while, and that we should all be that guy. We said it before on the podcast, but it just doesn't hurt to re-say it, right? If you're listening to Wall Street Wildlife, you are interested in stocks. I'm assuming you're not just showing up to see what hat Christoph's wearing each week, right? And if you're in our community, like, you have a chance to collaborate and exchange ideas and a bit of shit talk with like-minded investors. And, we all learn a bit from each other and we all try and teach a bit to each other. Well, you can step outside of that community and you can also just kind of show the way to friends and family members who kind of haven't discovered the incredible power of long-term investing that can completely change your life. So yeah, like if you're not having these conversations with your friends and family, then, maybe raise it over a Thanksgiving dinner or something later this year.
I'm glad you said that. I'm going to say what you said, but a little bit better. You know how there's this sad cliche about how awful it is to go to Thanksgiving dinner or, some family gathering because it's a bunch of people that get on your nerves and then it's just small chit chat and then people bitch and moan. How drastically different would those kinds of things, gatherings be if the family, instead of bitching at each other, is actually working together to help one another financially? And uncle said, hey, uh, I heard Monkey's pitch on Harmony Biosciences. It's really compelling. Susie, do you know about Harmony Biosciences? No, Uncle. What's going on with them? Oh, right. But and then the conversation goes, and all of a sudden you have people talking about authentic, interesting things. Like, yeah, they're curing this thing and that thing, and all of a sudden the conversation is meaningful. And so it's funny. It's funny to me. I don't know. It's a cultural thing. It's like people get weird about money and maybe they confuse themselves that they have to talk about dollar amounts. But if you're an adult, uncle or aunt or whatever, like why wouldn't you try to get the younger generation off the phones and doom scrolling and doing something fascinating that makes money and helps everyone?
Very good. Become, yeah, there you go. Share some animal wisdom the next time you're chatting to maybe a investing curious friend or family member. Hey, one thing before we wrap up. Like today, you've been all over the place. Like, what is going on? You're like an owl on video.
challenging week for me coming up. I got a lot of university stuff I need to take care of. There's a there's a mean old gorilla coming in to observe monkeys teaching. So you know how it is when you got someone looking over your shoulder and you gotta, so I gotta just a lot of other stuff I need to take care of.
All right. Well, hopefully you get through that. And don't let that distract you from our excellent episode 100 live stream that's coming up next week's episode. If you want to join the live stream, we're going to be recording it on Friday, the 26th. And I'm sorry, if you only listen to the podcast, you missed it because you're not going to get this until Monday. Our Patreons get the episode a bit earlier, but our Patreons know. So if you're only listening to us after the act, then yeah, you'll catch it next week, and you'll catch some of the fun and frivolity. We've got a whole bunch of games and interesting questions, and a lot of audience participation, and the $750 FinChat fiscal.ai/wildlife promotion.
Are you ready to become a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.